Okay, this is Wen Su. Thank you for joining us for this exciting webinar on real estate investment. Today we have three very interesting topics to cover. Let me start with the introduction of the speakers and the agenda. My name is Wen Su, and I will begin the presentation on Manhattan real estate trends. I am a real estate licensed salesperson with Keller Williams, New York City. I have lived in Manhattan for over 20 years and have witnessed the amazing transformation of this exciting city during this period, and I am very excited to have this opportunity to give you an overview of the city and share some of the trends in the real estate market. Keller Williams is new to New York City. However, we are the second largest franchise in the United States with over 700 offices in the U.S. as well as in Canada. The presentation will follow by Tony Danziger on real estate investment strategies. He will give you some tips on how to make an affordable real estate investment. Tony is a New York State licensed attorney who has been practicing real estate law for over 13 years. Tony is also a New York State licensed real estate broker and a broker owner of Dynamax Realty and Dynamax Realty NYC, both which specialize in property management and real estate investment services in central New York and New York City metro area. Tony is also a director sitting on the board of Manhattan MLS and currently serves as a vice president. Last but not least, we have Ida Milufsko. She is the account representative with Next Generation Trust. She will give you an overview on how you can utilize your retirement plan to invest in real estate. So we have some very interesting topics. Please type any questions that you may have in the right-hand chat box. Depends on the type of questions. We will either answer them throughout the presentation or at the end of the presentation. Without further ado, let's begin. So Manhattan real estate trends. People buy properties in Manhattan for two reasons: to be part of this exciting city as an investment or as an investment. As part of own use, generally is primary residence, pied-à-terre, or the rest of the country will call it second home, or sometimes parent buying for children going to school in Manhattan. And in terms of investors, we have both domestic as well as international investors buying in Manhattan real estate. What makes Manhattan an attractive place to live? It is a lifestyle choice to live in Manhattan. Manhattan is a cultural center, and it is an exciting city. It offers some of the best museums in the world, lots of cultural and art events, on and off Broadway shows, countless bars and restaurants and entertainment, and most of all, it is a cultural melting pot. Approximately 1.6 million people from all over the world living in this island of 22.7 square miles, and many people gravitate towards it. In addition to live in Manhattan full-time, pied-à-terre is a growing market from suburban commuters to empty nesters. It allows buyers to experience New York lifestyle on a part-time basis, and that's a market that we have seen growing. The exciting lifestyle is an obvious reason that people choose to live in Manhattan. There are also social changes in the past 2 decades that made Manhattan more attractive for families to stay here instead of moving to the suburbs. This includes declining crime rates and development of neighborhoods, often pushed by the city to meet its public responsibilities to continue to provide jobs and housing opportunities for all New Yorkers. New York City crime rate has declined by 80% since the 1990s, according to a statistic compiled by the police department in the city of New York. Manhattan is experiencing a baby boom that's unique among U.S. cities. According to an article in New York Times in 2007, since 2000, the number of children under age 5 living in Manhattan has grown by more than 32%. The data is relatively old. However, the trend has not changed. Back in the 90s, when I was going to school at NYU, I have never seen kids in restaurants. Now, strollers can be seen everywhere, and it is common for restaurants to provide high chair and crayons for children. For those who work in the city and have family, especially for people who work long hours, the proximity to work allows them to spend more time with their families rather than spending hours of commute every day. Neighborhoods are constantly changing and develop to be better as well. And oftentimes there is a big push by the city to make New York City a better place for people to live. For example, with the Lower Manhattan project and the development of the World Trade Center area, the financial district has become much more residential friendly, with many converted condos offering luxury amenities and luxury retail stores being opened in this area. Another area that's receiving a lot of government attention is the Hudson Yards. This is a formal proposed Olympic site, and it's south of Javits Center, bound by roughly West 42nd Street and West 30th Street, between 8th Avenue and the Hudson River. It is one of the last frontier available in Manhattan. Right now, it's underutilized with not much going on there. However, the 7th subway is expected to extend it to this area, and there will be residential condos, hotels, and a number of offices being built. So that is an area that will become a very developed area and with lots of commercial and residential uses. And some of the other neighborhoods that have been developed or up and coming, as an example, is the Meatpacking District, which you can still smell a faint slaughterhouse smell in the hot summer days. It's now packed with high-end retail stores, and with the High Line being built in the area, it's become one of the biggest attractions in New York City. And another up-and-coming neighborhood is Nomad, short for North or Madison Square Park. The area is sandwiched between Flatiron, Gramercy, and Murray Hill District, roughly bound by 23rd and 30th Street and 5th and Lexington Avenue. It has not been, the short nickname has not been used much since Nomad sounds like no man's land, and it has been kind of like no man's land in the past. However, this area is experiencing a renaissance with the influx of cultural and nightlife spots. Various hotels are being built in this area, such as Ace Hotel, the Gainsborough Hotel, and it is also the home to eatery of 50,000 square Italian makeup stores with lots of restaurants and grocery shopping. The Museum of Mathematics, which claims to be the only museum in the country of its kind, is also planning to move to this area. So this area is happening. For these reasons, more and more people are calling Manhattan their home. In terms of investment, Manhattan real estate market is relatively stable for investment. It's an attractive place for investment for various reasons. It has relative stable value compared to the rest of the U.S. The U.S. has gone through a significant housing price adjustment. Manhattan housing prices decline is relatively mild at approximately 15% versus the 46% drop nationally based on the data from Street Easy and Case-Shiller Index. On the graph, it shows Manhattan condo index based on Street Easy compared to the U.S. in general, as well as California and Texas, two extreme states where one experiences significant home price appreciation and a steep decline versus Texas, where it's basically fairly stable and not much going on. As you can see, the New York Manhattan condos have been trending comparable to the rest of the nation prior to the crisis. However, it has not experienced any kind of decline, and there's many reasons for that. For one thing, New York has not been experiencing the similar kind of impact due to the subprime crisis, and partly due to the property in Manhattan generally are comprised of either co-op or condos. For buyers for a co-op building, the board tends to have a much more stringent requirements than the banks, and even for condos, the board will need to review the applicant. For condos, generally, the condo cannot refuse the buyer. However, they do have the right of first refusal. So to the extent if the buyer is not highly qualified, while they cannot say no, they can take time and basically deter buyers that way. And another reason that Manhattan prices tend to be relatively stable is very low vacancy rate. As you can see on this graph, since 2004, Manhattan's vacancy rate has been below 2%, which is extremely low compared to roughly 10% of the vacancy rate nationally. That's the data for third quarter 2011. And as you can see, prior to the crisis in 2006, vacancy rate is as low as is below 1% on average, and during the same period, you can see a rent price increase between 9 to 13%, depends on which market sector you're in. And during the crisis at the peak, 2009, when the rent is still below, the vacancy rate is still below 2%, the rent has declined between 6 to 9%, and it's on the rise again currently. With the low vacancy rate, the owners of the property, if they are not willing to sell, they always have the option to rent out the property. Some other reason why Manhattan property is very stable is limited land. So there's a supply constraint. Currently, the condo prices are actually going up because there's very few condo development being established. And with the limited land, there is always opportunity. There is always a constraint on the supply side. Manhattan is also constantly being attracted to international buyers who support part of the demand side. So with the both supply and the demand side of the equation being either constrained or supported by these two reasons, the Manhattan relative real estate value has been relatively stable. So just a little bit basic background on what are available in Manhattan. You have there are three main types of properties in Manhattan: the co-op, the condos, and the townhouses. When you buy a co-op, you don't actually own your apartment. Instead, you own a share of the corporation that owns the building. The larger your apartment, the more share within the corporation you own. Monthly maintenance fee covers building expenses, including heat, hot water, insurance, staff salaries, and real estate taxes. Condo, on the other hand, you do own real properties, and a buyer owns apartment and shares the common areas with other residents. Condo has become more popular in New York City as new residential buildings are being built. Buying a condo is much like buying a house. Each individual unit has its own or her own deeds and own tax bill. Townhouses are freestanding properties that can be single-family, multifamily, or mixed use. However, townhouses comprises a very small percentage of the Manhattan real estate market. I believe the last quarter it's only about 3 or 4% of the sales market. Some pros and cons on the different on condos and co-ops. For co-ops, the biggest pro is it's a lot less expensive. On a square footage basis, it's typically between 40 to 50% lower than the condo. However, that's not really the best compared just because condos tend to have relatively lower maintenance and lower taxes. After adjusted for some of the differences in monthly cost and amenity that's offered in condos, the real difference is probably between 20 to 30%. However, co-op does have more stable residents due to limited rental activities, and the building experience less wear and tear in the same time frame. The board also sees screen away less qualified tenants. That, as I mentioned earlier, this is one of the reasons why Manhattan has not experienced any kind of home price decline as the rest of the country. The downside is the broker package can be extensive and the approval process can be very strict and lengthy. Typically, the board requires 2-year financial statements, tax returns, letters or recommendations from colleagues and friends, and also an interview process. And the co-op does not allow, and some co-op has much stricter policies, such as not allowing parents buying for children or owning as a hereditary, and there are restrictions on rental activities and regulations from size of the dock to proposed renovations, and financing is also tends to be a lot stricter. Generally, what I think is between 75 to 80%, but definitely not above that. And there's also a flip tax associated to sales of the property between 1 to 3% paid by the seller, and this is mainly to deter speculation. Maintenance is also can be higher due to building is older and require more maintenance and upkeep, and the possible mortgage on the building. So this is you can have a mortgage on the individual unit, and the building itself may also have a mortgage on it, which could increase the monthly maintenance. Condos, on the other hand, if it's a new development, there's no board approval process, so the process could be very straightforward and simple. And board approval process application is required to be reviewed, but as I mentioned earlier, it's based on the right of first refusal. The board cannot, if the board decides to refuse the applicant, the building basically has to buy it from the owner. So most likely the building will not do that. Financing is also a little bit more lenient. Majority of buildings are allowed up to 90%. There's also a lot less restriction on policies such as renting, renovation, or using it for creditor, and it's therefore it's much more investor friendly. New building also have much more contemporary designs and lots of amenities and services, and very much focused on lifestyle. And many new developments also have tax abatements, which can bring the real estate tax significantly lower during the abatement period. However, the downside is it is a lot more expensive than as I mentioned earlier. And for new developments, financing could be an issue if the building does not have enough contract signed, and the lender may not be willing to lend to apartments in those buildings. And closing costs could be higher since for new developments, if you're buying from a sponsor, they typically pass all the closing costs to the buyer, including transfer tax and lawyer fee and so on and so forth. Some of the current real estate trend in Manhattan, while prices experience seasonal fluctuation and the market slowed down in the second half of 2011 due to geopolitical events such as S&P's downgrade of U.S., the ceiling debate, and the financial crisis in Europe. However, Manhattan real estate market in general is healthy and prices is relatively stable. And inventory continues to decline, mainly due to decrease in condo inventory. Since reaching its peak in first quarter 2009, inventory has dropped by 32% according to Cochran. This trend is expected to continue since there are very few development in the horizon. A lot of condo development were developers decide not to move forward with their projects during the financial crisis because they could not get financing, and it takes some few years for a project to be finalized. So during this time frame, in the next couple of years, there will be very limited new development available. The luxury market, which is top 10% of the market, is doing very well with record-breaking sales. The most recent sales with 15 Central Park West had a penthouse owned by the former Citibank chairman, Sandy Weill, was sold for $88 million to daughter of a Russian billionaire who is going to school in New York. So that kind of ties to how international investor is impacting the market in Manhattan. Here are some data related to the fourth quarter 2011 market data. As you can see, slight decrease in the home prices, the co-op prices, but you actually see price pick up in the condo. Next, I will pass on the presentation to Tony Danziger, who will talk to you regarding some real estate investment strategies. Thank you.
Okay, well, thank you very much, Wen, for that presentation on the Manhattan real estate market. I think that any of you who have been to Manhattan recently, or at least in the last 10, 15, 20 years, can probably attest to the fact that such fantastic neighborhoods like Soho and Tribeca really are some unique markets, of any market, real estate market in the world. And as a real estate attorney who represented many, many developers who started investing in those particular locations, back in the 70s, I can tell you what they had was a long-term view. When you're investing in a market where interest rates are sky high, where the neighborhoods are distressed, the properties are distressed, and you have buildings that are condemned, abandoned, squatters living in them, those people, those investors who looked at the future and took a long-term approach to investing, they were the ones that continue to benefit from that long-term approach. So I wanted to take that and segue into my presentation, which is really about whether or not people should be investing today, and why actually they should. Most people that were investing in the early to late 1990s, early 2000s, many of them were investing in places like Florida and Nevada and Arizona, places where they could take no money down and basically buy a brand new development. 2 or 3 years, they could expect their investment to double, and many of them experienced that. Unfortunately, they were creating a bubble, and that bubble burst. Many of those investors are now priced out of the market. Their credit history is so poor that they wouldn't be able to invest in real estate today. But there are reasons why you should invest today, why you should consider making real estate investment a part of your overall investment strategy. Even though today's economy remains uncertain and volatile, we don't have any quick returns like we did before. We've had property values that have tumbled and foreclosures that have soared. Banks are requiring more money down, and they have tougher lending requirements, but it's a buyer's market. And people who are cash buyers certainly have the advantage. If you're a cash buyer, whether or not you are offering the asking price, you can offer way less than the asking price, and your offer is going to have more strength, more value to it than somebody who's offering more money, but who's going to be financing their purchase. And that's basically because when somebody's looking to finance, there's never a guarantee that a bank in today's economy is going to approve the loan. Another reason to invest in today's market is because we have a flood of investors, a flood of people out there who can no longer afford to live in the home that they bought. So they're being foreclosed on, they're being forced to short sale their property. Well, they have to live somewhere. The question is, where do they go? Well, they usually stay in the neighborhood that they're living in, but most of them have to now rent. And when you have renters that are starting to flood the market, what it does is it creates increased demand. You have real estate, which is basically a limited supply. We can't just build it overnight. And basically, when you have a limited supply and you have increasing demand, that basically increases the rents that landlords typically will get. My company, I have 2 property management companies, and we manage properties in the New York City area and in central New York, particularly in the Syracuse, New York market. We've been noticing that rents have been steadily increasing over the last couple of years. It's been taking less time to rent out properties that are vacant. So we are seeing the benefit of people moving into rental housing. Additionally, you've got interest rates that are historically at the lowest level they've pretty much ever been. If anyone has followed the Fed policy meeting that they had this week, basically they've outlined that over the next 2 years they're going to seek to maintain interest rates at the levels that they have today, which basically means that as investors we can finance deals with with knowing that we're going to be able to finance them at very, very, very low rates. So that is good news for the investor. Of course, having the money and being able to finance a deal is very, very important. Obviously, if you can't finance a deal with a loan, if you don't have the money, you probably shouldn't be listening to this webinar. However, but that's not necessarily the most important thing that you should focus on as an investor or a potential investor. Equally important is being disciplined. Discipline is the key. You've got to determine what your budget is. Many people that I've worked with in the past, people that I now manage their properties for, or people that I've represented, working with short sales or foreclosures, many of them got into trouble because they borrowed money that they didn't have. They didn't borrow it from a bank. They borrowed it from their savings. They borrowed it from their credit cards. They borrowed it from their 401k. Basically, they were leveraging what they had to invest in real estate when the market was just booming, where prices were skyrocketing. They were speculating. They were gambling. They were gambling with their savings. And when the economy tanked, they had no savings. They were maxed out on their credit cards, and basically they were forced into foreclosure, into short sales, and many of them have sworn off investing in real estate forever. That's not a good way to invest in anything. What you have to do is determine what your budget is, first of all. Figure out what you have that you can safely invest. Think long term. Make sure you always have enough savings set aside in case of an emergency. Always invest for growth. Never invest for leverage. Never speculate. Never expect that you're going to double your returns or triple your returns in the next year or 2 years or 3 years. You always want to try to acquire a property that's going to yield a stable return, and that requires some research. And if it's research that you can't do yourself, it's research that you should do with the assistance of a professional real estate broker who's familiar with real estate investment, the assistance of an attorney, of a contractor, of a property manager. Okay, and most of all, you want to think long term. So what are the steps to becoming a real estate investor? You have the money. You're sure you can get loan financed from a bank. Well, what do you do now? Well, first you have to select your target market. Explain many good reasons why people should invest in Manhattan. People from all over the world are doing that today, and they have been for many years. There are other places that you can invest in throughout the United States that do provide a stable return. And some of those places you may never have heard of. Places like Reading, Pennsylvania, or Scranton, Pennsylvania, or Syracuse, New York, or Rochester, New York. These are places where historically you found stable market prices. You've not had bubbles, real estate bubbles in those markets. And basically you didn't have the problems that you had in places like Florida or Arizona or Nevada. Once you select your target market, you need to associate yourself with a real estate broker. Find someone who's going to help you focus on certain areas that have strong, stable markets. Set the parameters before you start looking at properties. Find out what kind of a property you want to invest in, and find out what kind of return you feel you can get from those types of properties. What types of rent can you expect to collect? What's going to be your operating costs for those types of properties? Once you've established your parameters, start looking, find a property that's suitable for you, make an offer, and you're ready to go. But first things first, you need to select a target market. Never focus on one place. Compare markets. If you feel that you want to invest in a place like New York State, for example, don't just look at one particular neighborhood in New York State. Don't look at one city. Look at many cities. Compare the rents. Compare the property taxes. Compare the property values. Look at the statistics. How many foreclosures has that particular city experienced over the last quarter or over the last year? Have they gone up? Have they gone down? What are the property management fees that you're going to be paying a person who's going to be managing your property? How do they compare from city to city? Does it cost me more to hire a property manager in Albany than in Syracuse? Find out what all of your costs are going to be before you start looking at a property. Find out what your costs are going to be. Find out what your expected gross rents are going to be from those different areas, because rents can vary enormously from one city to another city. Taxes in Syracuse are about $3,500 a year, whereas in a place like Albany, they may be slightly less. The returns in Syracuse might be more than the returns in Syracuse. The rents might be higher. The property management fees might be different. So you definitely want to compare 3 or 4 different markets. The next thing you need to do is, once you have an understanding of what you're investing in and what your expected cost and income is going to be, start talking to local professionals, the people who are involved in the real estate market on a daily basis. Talk to real estate brokers. Talk to real estate attorneys. Talk to local investors. You may have friends who have invested there. Go on to various websites that focus on real estate investing. Talk to people who have invested in those neighborhoods. Even people who haven't necessarily invested in that particular state can give you good insight on what you should do when looking for a solid investment opportunity. Once you've determined what your target market is, your city, let's say, explore it. Take time to visit. I can't tell you how many clients I've had over the years who have bought properties in the Syracuse market, for example. People who are from out of town, who've never been to Syracuse, yet they heard a few news stories about, a proposed development of a mall or whatever, and they speculated. They bought properties, and they invested in Syracuse without doing their research. Syracuse is a great place to invest. I have many investments in Syracuse, and I have a good growing business there. But no matter where you invest, you have to invest in the right place. And you can't speculate. You have to know what you're buying. You have to buy in the right neighborhood. You have to buy in stable neighborhoods. Okay, you want to understand the local economy. Who are the major employers? Are you interested in a particular city? Well, how many employers do you have there? Big employers. Do you have manufacturing? Do you have universities? What is making that economy run? Is it based on just one major employer or 2 major employers? If one of them folds, what will you do? What's going to happen in that local market? Okay, so you want to invest in a city where you have a number of major employers that are keeping the employment stable in that particular location. You want to look at the employment rate. You want to look at property values. Have they maintained stable? Have they been stable over the years? Look at the property taxes. And again, don't be afraid to join online forums and local investment clubs. They can be a great source of information, and sometimes the best information you're going to get is the information that you get from people who are experienced. You can read a lot of books, and you can read a lot of reports and look at a lot of statistics, but at the end of the day, what really matters is your experience. And starting small and working yourself into the habit of real estate investing, that's how you're going to get more experience. And talking to people who have been through some of the problems that you're going to hope to avoid. Once you've established what your target market is going to be, you want to find a real estate broker. But you need to talk to different brokers. Don't just go to the first person that you find on the website. Don't just necessarily go to a broker who works for the biggest firm in the city. Do a little bit of research. If you know somebody who's invested in that area and they're comfortable and they're happy with their investments, ask them for a referral. Ask them who they work with. Talk to these brokers. Ask them what experience they have in dealing with real estate investments. Many real estate salespeople and brokers have a lot of experience, but not always doing the same thing. Some of them are focused on doing nothing but leasing. Some of them are focused on working with people who are looking to buy a residential home for themselves. Some of them specialize in working with investors. You want to find a broker who can understand your needs as an investor. What do you need to see? You don't need to buy a nice house. You need to buy a house that's going to give you a positive cash flow. Okay, and a broker's not there to be your advisor, your investment advisor. They're there to help you find a good property, but they need to understand what makes an investment property function, what makes it run well. They need to understand what the local rents are, not just what the local prices are, what the market value of properties are. They need to understand what the market rents are for that particular neighborhood. Otherwise, they won't be able to tell you whether or not you're making a good investment. They also have to have an eye for the structure of the home. Again, licensed real estate brokers are not home inspectors. They're not contractors. They're not appraisers. Their function is not to point out a leaking roof or a furnace that may be reaching the end of its life. However, real estate brokers who have experience with investment properties do need to keep an eye out on these things. They need to know how to ask the right questions to other brokers, okay, who they're dealing with when they're negotiating a deal. So always work with someone locally who has the experience in dealing with investment properties. Okay, and don't be afraid to ask your broker to tell you what tools that they use. Okay, do they do an analysis of whether or not you're going to be making money? Do they use different formulas to determine whether this particular property is going to generate a return? Do they know what a cap rate is? If you told them, if you wanted them to figure out what a cap rate is, do they know how to figure out what the net operating income of a property is and figure out whether this particular investment is going to be better than, let's say, the other house that you looked at on the other side of the neighborhood? So you want to ask your questions to your broker on a regular basis. You want to keep them involved, and you want to keep them, actively involved in determining whether a property is a good investment. Okay. Once you've selected your broker, let them know what your budget is. Let them know what your budget is. If you're financing the property, get a pre-approval from a bank. Don't start looking at properties unless you've gotten a pre-approval. If you don't have the cash to buy the property, get the financing, get the pre-approval. Most sellers today will not even consider an offer that you make unless you can show in advance that you are a qualified purchaser, that you have the wherewithal to buy that property. Okay, so before you even start looking, get a pre-approval from a bank. It takes 10 minutes to do it. Okay, another good thing about getting a pre-approval if you don't have the cash is that the banks will let you know what you are going to be approved for. So if you're only going to be approved for a loan of $50,000, then you know that you're not going to be able to buy a property that's much more expensive than that. Okay? So you want to get a pre-approval so that you know what you're going to be able to, how much you're going to be able to invest, what your price range is going to be. Okay? Get rental comps for your target market. Okay? Know in advance what rents, let's say a two-family house in Syracuse is going to generate for you, or a condo in Manhattan. Know what rents you can generate. Okay? You're going to need to know that because you'll never be able to identify whether a property is going to be profitable for you unless you know what the rents you're going to be collecting are. Okay? And what I would suggest is always tell your broker before we start looking at properties, I'd like to receive a comparative market analysis for the rents in this particular area. Let me see what a one-bedroom is getting, what a two-bedroom is getting, what a three-bedroom is getting. I want to know what the market is giving out right now in terms of a cash flow. Okay? Next important thing is don't buy a house just because it's cheap. It may be cheap, but it also may need a lot of work. Okay? So when you go into a property, try to distinguish between a fixer-upper and a turnkey property. A turnkey property is basically something that is ready to run immediately. You're going to buy it, you're going to rent it, it's ready to go. It doesn't need a lot of work. Okay? See cash flow properties. You can expect to get a 4 to 10% return. Let's say, for example, in the market like Syracuse. When you're doing your calculations, Always set aside 5 to 10% of revenue as a budget for repairs, and always expect that you're going to have a vacancy rate of 5 to 10%. Okay? Once you've got all that established, then you need to start looking. And the first is be patient. Many investors want to buy the first great thing that they see. That's the wrong approach. Sometimes you have to look at 50, 60, 70 properties before you find one or two that are worth investing in. Okay? And view as many of them as possible. Know what you're getting. Unless you view many properties, you won't be able to compare them. Okay? You don't have to be a contractor or a home inspector to know that the roof is falling off. Okay? So you want to get a sense of what you're buying, and the only way you can do that is by walking into those properties yourself. Okay? The numbers on paper look great, but again, does it need cosmetic repairs or does it need major capital improvements? Okay? And the things that you always want to look at are the roof, the furnaces, the hot water tanks, the plumbing, the windows, and the floor. Okay? Do these need to be replaced? How old is the roof? How old is the furnace? How old is the hot water tank? Those are your biggest priced mechanical systems that you have in a house. Okay? And a seller can tell you how old the roof is, or the furnace, or the hot water tank. So you want to get a good idea for how old some of these mechanicals are. Okay, if you found a number of properties that you feel are going to work for you, don't be scared to go back to those properties with a home inspector or a contract, a property manager, somebody who's knowledgeable with physical structures, and let them take a look at that and let them give you an idea of whether you've got good mechanicals in there or whether the roof is going to need to be repaired or replaced, and let them give you an idea of how much it's going to cost you to do those things. And always take notes and photos of those properties, and so you can have an idea of what you're comparing with each other once you're done looking at the properties. Okay? Once you've determined the property that you want to make an offer on, okay, then you're ready to go and make the offer. Okay, you've determined what your net operating expenses are going to be. You've determined what your income is going to be. Okay, now it's time to make the offer. Okay, you always have to factor in your reserves for repairs, vacancy rate, property management fees, utility bills. Always try to buy a property where the tenants are responsible for paying their own utilities. Many people invest in properties mistakenly by buying something that has one furnace that heats up a 2 or 3 or 4 family unit. Okay, you want to make sure that you have separate gas, you have separate electric, you have all separate utilities that the tenants are going to be separately metered for and that they're going to be paying themselves. You do not want to pay their utilities. The only exception might be for water. Okay, and don't forget, you may have to file property registration fees. If it's an investment property. So you might want to do a little bit of research or talk to a property manager who might know what the requirements are for that particular city or location. Okay? And that'll give you a better idea of what the costs are going to be for something like that. They're usually small, but it's a cost that most people overlook. Are you ready to make the offer? Well, if you are, then make it. Because if you snooze, you lose. I've been involved in work with many clients as well as for myself, where we saw a great opportunity and we just took a little bit too much time and we lost the chance to pick it up. So you always want to be ready that you can go in there once you've determined that this property is going to work for you. Be ready to go in there immediately to make an offer. Okay, and you need to find a broker who's going to be able to put in an offer the same day for you. Okay, don't be afraid to negotiate with the seller. I never offer full price for anything. Certainly don't offer them more than 90% of the asking price whenever you're making an offer. That would be the maximum I would ever start a negotiation with. I always try to do it much lower than that. Is the seller willing to own or finance? That's a good question to ask. It's a question you should always ask. If you don't have a good credit history, that might be a way to pick up a property. Will the owner be able to finance it for you? Will he hold the note? They often charge a slightly higher interest rate than what banks can do. But again, if you can get financing directly from the seller, that's another way to get a foothold in real estate investing. Okay. Once you sign a contract, you usually get a 10-day inspection period. You should always get a licensed inspector to take a look at the property, even if you've been there to the property more than once. once you sign the contract and you get that 10-day period, go back, take a licensed inspector, and make sure they go through it with a fine-tooth comb. If there's a problem, let them point it out to you. If the problem is serious, you can cancel your contract with no obligations at any time within that 10-day period. Okay. Always work with a property manager. Make sure you have somebody lined up once you're going into contract. You want somebody that you can trust. Best bet is to get a referral. Talk to somebody who's invested in that particular market and get a referral. You can get a great property, but if you get a lousy property manager, your whole investment can be ruined. Okay? So I can't stress that enough. And secondly, when you're going into this business, don't be discouraged by bad tenants. Don't be discouraged by the need for repairs. This is a part of the business. Okay? Can sometimes be a dirty business, a scary business to be in. It's very difficult to be a landlord. It's not so difficult if you have a good property management, though. So you want to have that person on your team at all times. Okay? And they'll be able to take care of all the day-to-day problems for you. And you will have problems because you're dealing with people that are not always in your control, those people being tenants. Okay? So think long-term, have a minimum 5, 10, 15-year time horizon. And if you have that kind of an attitude and you expect that at some point during that time you're going to have some interrupted cash flow, if you need to repair a roof or replace a furnace, those are things that are going to be expected. A house is like a car. It needs regular maintenance. You have parts that are being used, and they ultimately have to be replaced. So be prepared for that. It's part of the business, but if you factor in your vacancy rates, if you factor in a reserve for repairs, and if you pick it up at the right price and you have a good property management team, over the long run, you will have a good, solid cash flowing property that you should be very happy holding for many, many years to come. Okay.
Hello there. Here we go. So thank you very much, Tony. Just at this point of the webinar, we're going to go into a whole other faction, if you will. We're going to be going into self-directed retirement plans, which in essence is how can you utilize retirement funds for the investment of real estate as an alternative means to grow your retirement plan, which may not have been doing so well in the recent economy drop and recession through stocks, bonds, and mutual funds. What is Next Generation Trust? We are local professionals. We are administrators. We do all the necessary record keeping and IRS reporting as required by a custodian who manages an IRA or retirement plan. We are not a bank. We do not provide any sort of advice. We don't provide any financial planning, legal advice, or broker any stocks or bonds. We are neutral, unbiased third-party professionals, and we are focused on education and the emphasis on providing you with options to invest. We'll never tell you what you should or shouldn't do. That's what your legal counsel is for. That's what your financial counsel is for. That's what everybody else essentially is for when you make your decisions and do your own due diligence. What we will tell you is what you can or cannot do as far as IRS regulations go, and as far as planning your portfolio. So, with all the disclaimer and logistics out of the way, like I had mentioned before, we're not a fiduciary. We're just going to record keep and manage your account. So, say now that you are familiar with retirement plans here. Just to quickly go over the different options as far as retirement plans go, we have the traditional IRA, which many people are familiar with. This is your basic standard IRA that most people have with, say, like an entity like Charles Schwab, Fidelity, TD Ameritrade, something along those lines. It's a basic tax-deferred account. You can have that in addition to, say, your employer's 401k. and you have the ability to contribute $5,000 per year for your traditional IRA. If you're under a certain income limit, you can deduct that contribution, and any earnings that it makes will be tax deferred, with the assumption that you'll be at a lower income bracket at the time of retirement than you are at the time now, when hopefully you're making all your good money. So that's your traditional IRA. A Roth IRA is a fantastic vehicle in which you are contributing funds, again, limited to $5,000 per year, $6,000 if you're over the age of 59 and a half. And this allows for tax-free earnings. Your Roth IRA has a couple of facets to it that are pretty interesting in my opinion. You have the capacity, you have to be under a certain income limitation. That particular income limitation for 2012 is for couples filing, joint married couples, you have to be under $173,000 to contribute your full amount of modified adjusted gross income. So if you're under that, you can contribute. You can't take the tax deduction this time, so you'll still have to contribute. You'll still have to pay taxes on that $5,000 like you normally would. But any earnings that a Roth IRA would make is tax-free, provided that you have funded a Roth IRA for 5 years and provided that you don't take those funds out prior to the age of 59 and a half, which is the IRS-dictated retirement age. So the Roth is a nice plan if that's within your capacity to have. We recommend you speak with your tax advisors on that. The SEP IRA is basically a traditional IRA. It's tax deferred, but it's specifically for self-employed individuals. So if you are a full-time real estate investor, you may be eligible to have a SEP IRA, which gives you the capacity to put more funds into it than you would your typical IRA. For 2012, we're looking at about, I believe they raised it this year to $50,000. So you can contribute 25% of your salary up to a cap of $50,000 per year. So that's significantly more that you can put in, and that's tax-deferred income. Other plans you may be familiar with is 401k plans provided by your place of employment, or defined contribution plans such as a pension. Sometimes they permit, if you're currently at a job, sometimes your plan documents will permit you to self-direct a portion of that. It will also, if you have a 401k from a former employer that's terminated, you can roll that into an IRA and you can start using that for self-directed investments. Some specialty plans include a Coverdell ESA, which is specifically for child's education. You might be familiar with the state's 529 plans, which is specifically a state-to-state program, and that's specifically saved for tuition. The Coverdell is a federal program where you can contribute $2,000 per child per year, and that can be used to virtually any education expense, such as books, uniform that's not limited to college. You can use it for elementary school, middle school, private school tuitions, high school, you name it. There's actually a very broad definition as to what educational expenses are. But in the meantime, you can take the deduction when you contribute the $2,000, and anything that it gains is tax-free, provided that it is withdrawn and used for educational expenses. So to make that money grow, you can self-direct that too. A health savings account is for medical expenses. You specifically have to have what's called a high deductible plan. And if you have the high deductible plan, the IRS publication gives you medical options that fall under their qualified medical expenses. And it's the only IRS plan that you don't pay any tax going in or tax going out. So if you take your deduction going in and it's used for qualified medical expenses, you don't have to pay anything on its way out. So it's a very good plan. You specifically do have to have that high deductible plan designation. It's something you might want to talk to your tax advisor about, or your HR person, to see if you would apply to have one of those. Now, the first step in investing anything using your retirement plan would be to fund your account. You can't invest without funds. So you have 4 options when it comes to putting money into your IRA. You can make your annual contribution, which is out-of-pocket money, into a retirement plan. And like we had mentioned, there is limitations, which you can find on our website as to what your actual contribution limits are per tax year, per plan, or you can look at the IRS.gov website. You can make a transfer, which is moving. If you have an existing IRA, you can transfer to another IRA, one with us or with another self-directed custodian. You can roll over, which means you are going to, say, for example, you have that terminated 401k account that's now still in a 401k, which is not an IRA, but it's still a tax-deferred retirement vehicle. The funds would come out of the IRA into your personal possession. There will be tax reporting done, but then it will go back into, it'll come out of the 401k and come back into an IRA where we will do the next batch of reporting that shows the IRS that it stayed within a plan. If it's going from a 401k to an IRA, there's no time limit on that, and it's the only way that you can move funds from a 401k to an IRA. But if it's going from IRA to IRA, say you take a distribution and Schwab cuts a check directly to you, you walk over to Next Generation Trust and deposit that check, that's considered an indirect rollover, and you have 60 days from the time of the distribution to get that back into a retirement plan before taxes or penalties might apply for you. You can do that once every 12 months, like I said, unless it's coming from a 401k. The fourth is particular to Roth IRAs. In 2010, the IRS lifted the cap, the income limitation on people who can convert from a traditional tax-deferred plan into a tax-exempt Roth IRA plan. So if it makes sense for you, you can convert your existing traditional to a Roth IRA. You have to pay any taxes that are due on those funds, but those funds from that point forward will make tax-free earnings, which is a word that we all like here. So what's the meat? The meat is the investment. Now that you know all the details about opening an IRA, and of course you have any questions, you can feel free to contact us. But the reason why we're here is to talk about the alternative investments that you can make using those funds instead of being stuck in Wall Street with stocks, bonds, and mutual funds. It's easier to go through what you cannot do first because the list of that is significantly smaller than what you can do. The restrictions on investments within IRA falls under 2 categories. You have prohibited transactions, which are the types of investments you can't make, which include life insurance and collectibles. And then the second rule standing is that you cannot transact with a disqualified person. A disqualified person includes yourself, the IRA holder, your spouse, any ascendants, descendants, and their spouses, any fiduciaries of the account, such as your custodian, any existing business partners, and people who provide service to the account. What this means is if you're interested in using your IRA to purchase a house, you can't buy that house from your son. If you're using your IRA to finance as a way to make interest, you can't lend to your wife. That's considered IRS self-dealing and taking a benefit from your IRA prior to the appropriate retirement age and prior to going through the appropriate taxable channels. So what can you do? You can do virtually anything that you can invest day to day. So real estate is our most popular investment at this time due to the market being at such an affordable rate and that retirement investments are usually for the long haul. It's a great time to buy and hold on to that and do whatever repairs if you need to do and take advantage of the fact that you have this time before retirement. You can invest in real estate. Your IRA can directly own and take title to real estate. Your IRA can purchase mortgage notes. It can finance the purchase of another real estate purchase as an alternative way to continue to invest in real estate in the event that they don't have or the desire to own the actual piece of property. You can go through tax liens, sheriff's auctions. You can invest in companies that invest in real estate. You can invest in limited partnerships, offshore hedge funds, private stock, you name it, and you can invest in anything. It's just all a matter of appropriate structuring and making sure that you're not involving or going against that disqualified person's rule. In this particular case, real estate usually is what we see in one form or another is the bottom line that people want to invest in. So how would you do it? How would you invest in your IRA? For the example of the direct purchase of real estate where your IRA, a distinct and separate entity from you personally, would be investing and owning a property, these are the basic steps. First, what's not listed here is the first thing that you want to do is have your account with a self-directed retirement plan administrator such as ourselves open and funded with at least enough money to make a good faith deposit so you can act fast on any property you have. You can't put down a deposit on behalf of your IRA. You can't sign any documents on behalf of your IRA. You can do all of the research and the due diligence, which is encouraged, so you know what you're doing. But that's the limit to what you can do. So in order to do within your IRA, once your account is open and funded, you want to locate that investment property. You want to do the same due diligence that Tony referred to, maybe check out those Manhattan trends that Wen referred to, and once you actually find that dream house for your investment purposes, you're ready to go. You're going to continue to negotiate like you typically would. You're going to have all your inspections done, everything that ordinarily accompanies a real estate transaction. But you're going to do it all in the name of your IRA. Now, if you remember, your IRA is a separate entity from you personally. So anything done in John Smith's name is not valid in the eyes of the IRS. And any money that you've put down, you're not going to be able to move back into your IRA. So it's important that the seller understands that you're doing this through a tax-exempt or tax-deferred entity and that everybody's on the same page because you're going to be the format in which you're going to list the IRA's name will be Next Generation TS. For the benefit of your name, IRA, your account number. Once everybody's on the same page, you're going to submit that contract, and you can do it by fax or by email over to us with our instruction form, which is called the bi-direction letter, that says, my name is John Smith. I want to purchase 123 Main Street. The contract price is $100,000. There's a $5,000 deposit that I need right now. Or conversely, if it's a 123 property, you can go ahead and say, I'm going to be sending $110,563. That includes certain closing costs, inspection costs, etc. And according to that contract and those directions, we'll send those funds and execute that contract on behalf of the IRA and send it to wherever you tell us it needs to go. This is the basics on how to invest with a piece of real estate. Now, when you call and you have specific investment scenarios, you want to be as specific as possible because just saying that you're investing in real estate can really mean a multitude of things. If your IRA is going to take title, that's a whole other thing, and we can do it as many times as we want, speak to as many people as you need us to, so that everybody's on the same page and understands what it means to make an investment within the IRA. And that's basically how it works. There's, of course, different transaction procedures as it were, say, for example, if you're getting involved in a REIT or if you're collecting or working with several partners or if you have a small amount and you're investing in a company. The basics are the same in the sense that you must always do your due diligence, collect any sort of paperwork or instruction that needs to be done ordinarily, even if the IRA was not involved. Submit them to us to review and to sign on behalf of the IRA. We're never going to make an investment decision if you decide to purchase a house at a tar pit. We're not going to be the ones to tell you, I don't know that this is a good idea. It's completely and utterly up to you to The accounts are truly self-directed and give you ultimate control in the investments that you have. I think that's it for us here at Next Generation Trust. We're going to open the floor for any sort of questions. We encourage you to chat your questions in the box so that way we can address them. And I'm going to turn it over to Wen.
It doesn't seem like we have any questions in the panel. We'll wait for another minute or two. If we don't see any more questions, then we'll be wrapping up this presentation. So thank you to everybody for participating for this real estate investment webinar. And if you have any questions, feel free to contact me or Tony Danziger. Our information is on the presentation, which will be available on the web for at least the next 30 days. My number is 917-902-6489, or you can email me at wenhsu@kwnyc.com, and Tony's number is 516-489-4390, and you can contact him for any question related to the information. And thank you so much for attending the webinar.